My name is Andre Buck, Global Head of Sales and Relationship Management. Before we start, I would like to inform you about what you can expect in the next 60 minutes in logistics. We are using Microsoft Teams, which does not allow us to use the question function. Therefore, we will use Slido. I'm sure most of you know it. It's been widely used at conferences and webinars like this one. So please take your smartphone and go to slido.com and put in BörsenTalk 22. Now, for the ones who are not on screen, who are dialed in by phone, it's a capital B-O, capital T-A-L-K 22. So BörsenTalk 22. And that brings you to the Slido with the questions where you can, so if you have any questions during the course of the webinar, please use the Q&A area and type in your question. The panel will answer them, some of these questions in the last part of the webinar. I've prepared some questionnaires just to make sure you have access to it. And just 3 simple questions. Where are you following BörsenTalk and Mittag from? So are you sitting at home? Are you sitting in the office? Or are you somewhere else? And we will see in a moment whether it works. Some of you have taken part already. I see, yeah, it's counting in. That's very good. So you know the system, you know how it works. And I will just reveal the answers here. So we see it jumping around. So most of you are at home, 20% in the office. So quite interesting. Also, we here in the panel are in the office, mostly at home. So to give you the best experience. This webinar is also recorded and will be distributed to all of you in the coming days for your convenience to rewatch crucial parts or even all of the webinar again. So in that sense, that's all from my side. That's enough palaver. Let's start with the evolution of broker Algos and its impact on SIX Swiss Exchange. Please, Adam, the stage is yours.
Thank you. Quick caveat before we start, everyone. Struggling a little bit with one of our panelists, Vladimir's audio video. So I'm just going to ask if he can. Can you shout out, Vladimir, if you can talk? Doesn't sound like it. Well, okay, we'll keep working on that in the background. Marianne, if I can ask you to try and keep working on that, if you don't mind, please. And my other 2 panelists, Salvador and Mac, are you able to turn your cameras and audio on? Just checking that works. Yeah, perfect. Okay, we'll keep working. Vladimir, you're there.
Hello.
Fantastic. Half an hour of scrambling and we do it right in the nick of time. Thank you, everyone. Okay, diving in properly. Hi, everyone. Thank you for taking the time out of your day to join us for this panel discussion. I'm Adam Sherlock. I'm Head of Equity Sales for Europe at SIX Swiss Exchange. I'm joined today by 3 big hitters in the world of electronic execution in European equities in the forms of JP Morgan, Vontobel, and Instinet. At SIX, we recognize the significant amount of daily liquidity that arrives at our market courtesy of broker algos. As an exchange, we're working to ensure that those algos and smart order routers are pointed to us as often as possible. And we're trying to innovate via new mechanisms, order types, and liquidity incentivization programs to attract and maximize how much of that liquidity we as an exchange group can capture. But an equally intense battle takes place one step further back up the food chain, where our broker clients are innovating and iterating with their algo products in a similar manner to try and win the right to trade those buy-side orders in the first place. It's at this intersection between the exchanges and the broker technology that we're going to explore with our panelists today. So if I could ask to kick us off, Matt, followed by Vladimir and Sal, if you could introduce yourselves to our audience, and then we'll dive into a few questions.
Thanks, Adam. So, Matt Wertheim, I'm an executive director at JP Morgan. My role is looking at liquidity strategy within European equities, so focused on access to liquidity, whether that be externally or internally within the JP Morgan infrastructure.
So I'm Vladimir Flimonov. I'm head of algorithmic trading at Bank Vontobel. So we sit within the transaction banking and offer a lot of execution services to the clients. So my particular role is to structure the algorithmic part of it and deliver the best possible execution. So.
Salva Rodriguez, thanks for giving us the opportunity to be present here today. So I run execution services for Internet in EMEA, which is essentially everything that touches execution from high touch to low touch and everything in between, just making sure that we're trying to deliver the best possible outcomes for our clients.
Perfect. Thank you, Sal. Thank you, all of you. In which case, let's dive into our first question of the day. So, buy-side algo selection. When it comes to equity execution, I want to ask as an exchange how you've seen your client's selection of algo for execution. Their selection of algo has evolved over the prior years and continues to evolve. And what is the main driver, as you see it, behind the changes in this selection behavior? And if we could start maybe with you, Sal.
Sure, thank you. So it's a good question, and I think what we've seen from the very beginning, and I'm old enough to remember the very beginning. I shan't disclose my age, but old enough. And in the old days, used to send an order into VWAP and forget about it, and it did its thing, and everyone was happy. Now, clearly, a lot has happened in between, not least, MiFID II and related regulation that's imposed, I guess, more onus or kind of enforced the approach from both buy and sell side in terms of how people are looking at best execution and justifying that process. So we've seen a lot of evolution in broker wheel type activity. And I guess in the beginning, those sorts of things were quite simple. It was quite literally, I've got a VWAP benchmark or I've got an arrival price benchmark. And I think those benchmarks are still valid and still, very commonly used wheels across the street. But I think the flow types and characteristics have changed significantly. And by that, I mean, there is more quantitative input, both from the buy side and the sell side into, okay, what's the best approach and methodology to get to my desired outcome? And I think algos have evolved for sure, but I don't think necessarily that benchmarks have. Clients essentially still want to trade at the right prices at the right time, and we, as I'm sure my fellow panelists will attest to, we get hit straight away when an execution or price or the quality of an execution might appear to fall short of an expected outcome. So there is still a lot of to and fro on that, but I think in some cases we work, or in most cases try to work as closely as possible with our clients to see what it is they want to achieve. Clearly, you ask 10 people in a room for what they want to do, you'll get 10 different answers. So it's not necessarily an off-the-shelf type solution. And I think the way I look at it, actually, I like to simplify things, and we talk about, and the guys from Internet be bored of hearing this, but 2 pillars, which are essentially, how do I get good quality of execution, and then everything that falls below that, that's quant input, and how we're approaching different venues and the interaction that we have, and pillar 2 is, how can I find liquidity? So that brings in all the different options that are out there, whether it's conditional order types, periodic auctions, TAL, etc., etc. So those 2 pillars drive everything else, and we are constantly looking at delivering good execution. And the fact that we talk about conditional order types, the fact that we talk about arrival price benchmarks and complex flows and characteristics and below or above certain ADVs and thresholds, people still measure you versus arrival. People still measure you versus VWAP. People still measure you versus the close. So the benchmarks haven't necessarily changed, as I say. And that's evidenced by the fact that when I look at my own usage of vanilla algos, whether that's VWAP or POV strategies, they're still quite high, right? And when people are hitting their own buttons, people are still looking to trade VWAP. People are still looking to trade POV. People are still looking to trade auction. And I think that's driven by certainty of outcome. People know what they're going to get when they hit those buttons. If you talk about some of the more esoteric or sexier things that are out there, it's known what an algorithm is doing at any given point in time. And I think certainty of outcome is a big factor. I'll stop talking there to give the others a chance.
And maybe just a very quick question on that, Sal. Did you kind of reference bespoking, and do you think from an internet side, do you find yourselves doing more bespoking of algos than you once did, or is it pretty much as it used to be?
Yeah, I think I think that continues to grow. I think some people basically say, here's a piece of rope, go and hang yourself, and that means my benchmark is Arrival. You figure it out, you're the broker, and we'll measure you at month end, quarter end, half year end to see where you rank relative to my other brokers. I think some fall into that category. Others work very closely with us to, and it's about a partnership ultimately. The other guys I'm sure will agree that once you get into the weeds of particular flow types or particular sizes, particular ADVs, particular market cap, etc., not everyone's flow is the same. So I think understanding that and kind of doing analysis on that flow to create an optimal outcome, I think, is where we see huge benefits. So that has evolved. It's still evolving, but as I say, if you look at some of the vanilla algorithms, they're still massively active and massively used.
No, thank you. Interesting. And Vladimir, on to you guys. From a Vontable perspective, have you seen much of an evolution in how clients select and use your algo offering?
Well, yes, sort of, yes. And I think what Salha said about the certainty, that's what we see as well. So we work closely with the clients, and over the time, some of them have chosen a particular algo to be their favorite. So they tailor it to their need. They were able to suit it to particular flow type that they have with Vontable. And basically, looking at that, we need to disentangle this factor, because otherwise we'll just be measuring the flow of some clients. So if we take into account, there was an interesting trend that we observed, at least on our side, over the last 2 years. And obviously the benchmark, so the VWAP, is the dominant one, so it takes still quite a big fraction of our volume. But what we see growing is growing of the liquidity-seeking algos, and in particular, we have one called PACE, which has an opportunistic flavor in it. And we saw that over like 2 years, the share of this algo has increased almost 4 times in comparison to what it was. And so this demand on this opportunisticity of the execution, that's what we kind of see from different angles. So in the volume, we see it from the feedback of our client relationship managers. We responded to that to deploying another purely opportunistic algo edge. And it's totally, I think, what Sal has mentioned, the algo wheels, I think that's where it comes to. So on one hand, clients favor the certainty of execution, but on another hand, they are becoming more and more sophisticated. So they, on their side, can able to measure us better. They challenge us. They ask and demand for more detailed trade statistics from us, and I believe that this goes towards the execution wheel, the algo wheels that obviously have evolved. So, as Sal said, from purely discretionary to more systematic performance-based algos, and they can see when this opportunistic execution actually add performance to their flow. And on our side, we see it as a trend. So kind of, if I think Matt will agree that if we have to stay within this business for next 5 to 10 years, this performance-driven or the routing will be the standard in industry. So what we aim to is towards improving our performance of the algos, and that's kind of the main factor that we see, the risk factor for the whole industry. I don't know what, Matt, your opinion on that?
Great segue. Thank you, Matt. What's the JP Morgan take on that one?
So just taking a step back and looking at the business we have across electronic in aggregate, I think the trends that we see are different for different types of investors. So for the more institutional focused investors, as Vladimir mentioned, and we would agree, we see increased use of liquidity seeking algos, opportunistic trading behaviors, and that's approaching half the business in that particular segment. I think it's worth also mentioning in institutional space, we do see an increased focus on the close, both from passive index management clients, but also clients looking to opportunistically source liquidity in the closing auction. Those are kind of two algos within that bucket that we think are meaningful. Within the more systematic space, the trend has been more to shift away from direct market access to using SOR strategies to try and aggregate liquidity. And then in the more mid-frequency or event-driven macro hedge fund space, we see more usage of the VWAP algos that I think Vladimir and Sal mentioned, not necessarily to achieve a VWAP benchmark, but to achieve an arrival price using a passive execution mechanism. So that's the kind of JP view around algo trends across the last 3 or 4 years. Just picking up a few points that Sal and Vladimir mentioned, I think that wheel usage has driven a lot of the institutional push towards liquidity seeking, and that has meant that two things have arisen. One is performance measurement, and we would completely agree that clients have become increasingly sophisticated around how they measure performance, and we have been able to partner with many of them to collaborate on the thinking around how we think performance should be measured and how they do as well. So that's evolved into things like tiered rankings for wheels rather than absolute values, and understanding noise within measurements, etc. So that's been a real positive trend. And then picking up on something that Sal mentioned around kind of customizations and off the shelf, I think the focus on performance within a wheel means that you can innovate as a broker and provide access to differentiated liquidity or tweaks within the algo logic and framework to maximize the performance that you can achieve for the client, and also the execution certainty as well, as Vladimir mentioned.
No, thank you. Very comprehensive. Thank you for all three of those answers. I think the overwhelming thing that stands out for me from those three answers is growth in liquidity seeking algo usage, particularly by institutions. And I guess they're becoming increasingly informed when it comes to their selection of algos and how well they understand market structure. And probably that drives a lot of this, as well as the better logic that each broker's liquidity seeking algo has versus where it was 3 years ago. So that's great insights. Thank you. Jumping into another question then, dark pools. We're witnessing the continued growth in dark trading. Recent big XYT analysis noted that whilst pan-European dark trading represented just under 5% of total value traded in 2018, that's now up at 7.4% for 2021. At SIX, we tried to respond to this with the launch of Swiss at Mid in 2016, and have followed that up with the launch of conditional functionality in December last year. And Swiss at Mid now captures close to 40% of the Swiss equity non-display market. So when it comes to dark routing, how has your use of non-display venues and liquidity evolved in your algos and order routing? And maybe starting with you, Vladimir, this time from a Vontobel perspective.
Well, at Vontobel, yeah, correct me if I'm wrong, but I think we were one of the few early adopters of Swiss at Mid. So it's been always a very important source of non-lead liquidity for us, and we're super happy with this service. And the non-lead liquidity for us important because we essentially try to offer as much pools as we can to our clients, as much of alternative sources of liquidity. And obviously the other dark venues, gray venues are quite a big important. So, it's slightly difficult though to measure it internally because of the no pre-trade liquidity, pre-trade transparency. So you always measure, if you measure from your side, you will measure the allocation conditioning on the logic which you have already in the algo. So it's not just completely separately from like you can, for example, measure the MTFs versus the primary in your flow. But what we can see is what the allocation of clients to a particular algos. So as I mentioned, the pure liquidity seeking algo, which try to capture as much as possible pools and being opportunistic on the lead venues as well. So it captures quite a lot of interest, But if we try to look at the pure dark, so obviously we offer the pure dark, the pure gray, the sniper, so the classics, which every broker, I guess, have in their portfolio, we see quite some dynamics, and it's hard to say whether it is reflecting more our clients or the industry, but we saw actually the need for the dark liquidity as a pure dark algo decreasing over time. So since beginning 2020, it's quite decreased a lot, maybe 50–60% roughly. And at the same time, we saw that the clients demand on a pure algo-based more the gray liquidity. So obviously the periodics and the internalizer became quite an important source. And that's not how you allocate, that's what clients demand from you. So obviously we try to use everything within the SOR. We try to balance smart to the router. We try to improve both the price and the fee for the client. But I think that's an interesting trend which kind of reflects the changes in the quality of the dark liquidity over the time. That's how we see it from our side, and I don't know what's the colleagues could say about that from their clients' side.
No, thanks, Vladimir. And maybe to you, Matt, do you see a similar shift where net more demand for what Vladimir refers to as grey liquidity, be that SI or periodic auction or other grey source, RFQ, etc. Do you see that having risen versus dark, or do you see a different landscape of how you're allocating liquidity?
So I think periodic liquidity is clearly a important source of liquidity across the external MTFs that are available across Europe. We see that arriving at a steady state, and the kind of proportion of activity across dark versus periodic has been pretty consistent over the last 12 months according to our numbers. But clearly periodics were a new advent of MiFID II, and that growth and importance in the first couple of years of MiFID II implementation, there's clearly a lot of growth and focus on periodic auctions. I think that talking about periodics, there's obviously different order types that have been launched from periodic venues, and I think you can infer that people are using periodics in different parts of their routing methodology to source larger style liquidity, to kind of look at kind of quasi dark liquidity, but also more urgent spread crossing type flows interacting with periodics as well. So I think that's similar to what Vladimir was saying. One point I wanted to mention was around access to blocks. Clearly blocks is a very vogue topic in Europe, potentially more so than other regions, and we see increased competition across conditional venues. Obviously, recently SIX have launched their conditional dark venue, Swiss Mid Block, which we are connected to. We feel that's a helpful advent to the kind of block market structure, given there's increased competition, and we see 4 or 5 venues having pretty decent market share in blocks. The JP perspective on block activity, I think, is around channel conversion. So taking kind of electronic mechanisms and folding in high touch services and also potential risk provision in block size. I think that's a trend that you will see more of, and we have seen a lot of growth in those types of activities over the last couple of years. I think that when you think back around algo usage maybe 5 years ago, you were stuck to one particular channel, but nowadays via an electronic pipe you can access multiple sources of liquidity, including high touch and risk, as I mentioned. So that's the other piece. And if I may, just one other point around dark activity within other parts of SOR. We do see increased use of dark activity as part of aggressive routing, whether that be as periodics, as I mentioned before, but also darks to source price improvement when crossing the spread. And one of the things that the industry has developed that we quite like is the use of dark lit sweep order types, because there's no kind of ability to be jumped in the queue when you reach exchange. And again, that's something we're very happy with leveraging with SIX Exchange.
Thank you, Matt. And it's interesting to hear that perhaps more than dark pools being used more frequently and opportunistically within the algos, it's periodics, and perhaps because they represent that lit fill or grey fill, but lit technically fill versus a dark fill when it comes to clients opting in and out of whether they want dark interaction on those parent orders. Same question for you, Sal. What's the internet take on kind of evolving use of blocks, dark?
Thank you. I mean, I agree with what Matt and Vladimir have said, actually. And I think if we take a step back, I think unanimously feedback from clients directly is that midpoint trading in dark is good, right, for their workflow. So I think you start from that premise, and I think that creating a solution for that kind of ask is important, and we will do it slightly differently, but you know, the end goal is the same. We need to access that liquidity in a sensible way that shows good additive liquidity accessed in the correct / intelligent way. And I think then that how it differs comes down to each broker, how their SOR works, what venues they connect to. I think Matt made the point around connectivity to, I'll say all, but you know, as much as you can in a sensible way. And of course, we measure those things, as I'm sure everyone does, to see where we get our bang for buck, and you know, from quality of fill to latency to all sorts of things. But I think, yeah, we start from the point that everyone expects that having good access to good dark liquidity is good, albeit some of the politics around it from a commission level might argue the other side of that, but we don't want to draw into that. But so I think yeah, the periodic point was interesting, actually, because I agree. You know, when it first came out, and that was led really by, I guess, Exchange Innovation to a point where they tried to figure out the MiFID II solution and create this thing, and we've seen the growth of that. And I think there was a bit of a and at the time. How do we incorporate it, even from clients? What does it mean? What does it look like? Opt out for now. Let's wait and see. But now the de facto is, yeah, why wouldn't you, right? If you don't, you're probably an outlier. So I think people have recognised that there is good quality liquidity to be had on those mechanisms. We all know who they are, but so I think there's been substantial growth, and people are seeing it as good benign liquidity. And I think that's just part of the workflow, and I think it's just part of the waterfall that everyone has in their own system and approach. I think to the block point, you know, as I think Matt said, yeah, fully supportive of conditional flow. We think from an internet perspective, we think that that's the most effective block seeking solution, the conditional. Then how you wrap it up, you know, you might bring in some risk, as Matt said, or you might bring in access to different things that others might not have, or you lean on the technology that you may or may not have to access different things quicker than others. And so, you know, the relationship between the venue or provider and the technology that helps you get there is important, and you know, we shouldn't underestimate that technology piece. Continued investment on that in that to make it or to maintain it and enhance it. And I think, you know, you've seen a lot of innovation in the blocks space. You know, even recently there's been 1 or 2 press releases around different things, and people still see it, and that's evidence that points to evidence that people still care and see that as important. I mean, not least with us, with, you know, things like block cross and stuff like that. So so look, we fully acknowledge that that is very important. It's hard to break into, in some cases, hard to break into some of the kind of incumbents, and I think having unique access, unique liquidity, incorporating it into workflow, importantly, is key for, I would say, for the buy side user. You don't want to give them additional buttons to press or additional GUIs to interact with. You know, incorporating something, a solution into existing workflow is important. And I guess also the point around, I think Vladimir made the point earlier around, you know, used to have standalone dark access, but now that's kind of incorporated into a vanilla algo, whether it's via a wheel, whether it's via a vanilla VWAP type strategy, or a liquidity seeking strategy. You have that dark component. So you've got the standalone algo as is, but you've got this other thing working in the background, constantly looking for that liquidity, sourcing that liquidity. So yeah, it's definitely evolved, and look, we see, you know, you mentioned the big XYT number, which is, you know, self-explanatory, and we see the growth in the different venues as per, you know, the Rosenblatt stats and so on. So yeah, definitely a key focus for us, and I'm sure the rest of the panelists, to make sure that we're accessing those venues in the right way, measuring the liquidity and the quality of execution, and enhancing the technology to enable us to access that ahead of anyone else, I guess.
No, it's interesting. Thank you, Sal. I think there's 2 things. The headwinds of you know, potential changes to MiFID around further limitations being applied to dark trading is going to be a really interesting one that will probably evolve the answers to those questions in the coming years. But picking up on one thing you mentioned, Sal, which was buy side attention to making sure you have maximum liquidity access. And I guess it's a question for anyone who wants to jump on it. Do you think the buy side are more in tune now with saying, I know which of my brokers can get me to all of the venues and use all of the order types than they once were, as a benefit of wheels and just a greater analytic ability when it comes to looking at their flow? And has that driven some of your needs and demands from them to access just about everything that you could print in?
I think 100% it has. Just very quickly, that I think most buy side firms now have the ability to engage with us on a quantitative level. They analyze. It's no longer us saying, look how brilliant we are. Look at this performance. When you trade with us, it's fantastic. No, they scrutinize it. They've got smart people looking at the numbers, number crunching, telling you you're good, bad, or indifferent. So that, of course, has resulted in people like us on the sales side to up our game and make sure that we have the relevant quant personnel to analyze, digest the feedback, analyze the flow, and what I call the what if scenario. What if we've done this slightly differently? What if we've gone left instead of right? What if I recalibrated it to be this instead of that? And as I say, you need, that's way beyond my skill set for sure. So we need people that are able to analyze that and provide sensible solutions for us, so that we can then go back to our clients and say, look, we've looked at it, we've seen that it delivered this. Our suggestion is to recalibrate in this way, and we think it's going to give you this. So 100% it has kept us on our toes, definitely.
Fantastic. No, great insight. Thank you. Matt, you want to jump in on the same point?
Yeah, I think in terms of kind of breadth of liquidity, clearly having breadth is important, but I think it's fair to say that you need to have access to the right liquidity at the right times as well. So, dark liquidity is very useful, and I think every panelist here has said that in one shape or form. But clearly, we do get ping from clients from time to time around adverse selection in dark, and having kind of price protections is obviously critical. And when you have scarcity in terms of your order size versus a typical trading size in dark, you need to be selective around the dark venues you use as well. So those are important considerations to make around use of order types, different venues at the right times to achieve the right outcome for a client.
Thank you. New topic, and apologies to our panelists because I'm going to go in a slightly different order than maybe we'd pre-discussed, because I want to make sure we cover some of what I think are the best questions before we run out of time. Data center fragmentation, data center shifts. With Euronext's planned data center move from London to Bergamo, that's well discussed and publicized, they'll be joining the 2 SIX equities exchanges, the Swiss and the Spanish markets, by matching on mainland Europe. By my reckoning, that brings more liquidity than in recent memory to trade on the continent. And we wonder, for all three of you, what questions and considerations does this raise from an algo product perspective? And perhaps starting with you, Matt, this time, what's
Sure.
JP's insight on that?
So I think in terms of consistency and simplification across an algo and SOR stack, having fewer locations is potentially easier to manage technically than having multiple locations across different geographies. So there's a technical point around kind of maintaining presence in a select group of locations and only expanding that presence as and when you need to. With that in mind, and given the Euronext move to Bergamo, we're obviously looking at the market and have looked at the geographic latencies for all the venues we access, whether that be primary or MTF, across multiple locations around mainland and the UK, Europe. And I think the conclusion we've reached is we're happy with our existing presence, but we continue to analyze and look at the relative latencies across different markets, etc., to see if there's any change in that decision-making process. That said, post-Brexit, clearly there has been a focus on Europe, and we've recently launched a JPM SE entity in Europe and have dedicated traders on the continent to source liquidity for European clients that are domiciled in Europe. So we do see that we're investing in Europe, and we think that's a very important strategic play for us as a firm. And just in terms of the the considerations around how you route liquidity and where you're located. Clearly, our end goal as an operator of an SOR is to manage fill rates when accessing venues at the same time, and clearly optimizing the SOR to maximize that fill rate when you have to access both MTF and primary liquidity is the key consideration for us. And I think we're happy with how we do that and the periodic monitoring and improvements we make in that space as well.
Oh, that's really interesting. Thank you. Maybe on to you, Sal. Internet perspective, market data fragmentation, Euronext move, other moves that happen in the market. What's sort of Internet's plan and take on?
Yeah, I mean,
ensuring you
similar theme to what Matt's just explained. Actually, I think just kind of from a top down level, I think there's obviously a third-party hosting point as well, which I guess makes it open to more versus the previous location in London, which is an interesting thing. I think the point around the SOR and latency is important. I think the ability to be co-located at various venues is important to be able to access them. I think the point Matt made around having good access to the various venues, but shouldn't underestimate the increased latency that this potentially introduces. By my non-mathematician reckoning, it's about 35 times slower. So from 200 micros to about 6-7 millis. So there's a latency point there to consider as well. So what could happen with that? I think maybe things like IOC hit rates could be impacted if people don't have the adequate technology or aren't co-located correctly in the appropriate way at the right venue. And I think the point Matt made around technology and SOR, there will be additional costs potentially to brokers looking at the IT infrastructure, developing the SOR, making sure it's fit for purpose, making sure it's doing the right things. Things that happen in the background that people don't appreciate. And apart, I'm sure my panelists would agree. Things in the background for us, things like network teams or data center connectivity teams, technology staff, that kind of thing that are front and center with these types of migrations from one venue to another or one location to another. So I think that brings additional costs to the sell side, and so that's something to consider. The other thing which I think was touched on as well is potentially introduces more divergence post Brexit, UK versus EU, and how that liquidity might look going forward. We see some European MTFs increase share or have seen them increase share, and some UK venues decrease share. So we'll see if that concentrates liquidity. Whether this move concentrates liquidity in some way, that we want to watch, I guess. But yeah, I think some of the big items are the latency point and the potential additional costs in terms of technology and infrastructure from a networks perspective. But I guess the good news is that in theory it's open source, so anyone can connect to that venue.
Yeah, no, thank you, Sal. It's very, very interesting. And just as a quick segue, if there are any questions from anyone on the audience, please feel free to send them in via Slido, and we'll get to those at the end. On to you, Vladimir. I know that, well, please correct me if I'm wrong in saying that I think the outlier in the group are Bontable with regard to where your technology sits.
That's
being
right.
with us in Switzerland rather than with your two colleagues in the UK, which obviously the Bergamo move probably in some way plays to an advantage for you guys. But what's the Bontable take on market data center fragmentation and the migration of those, and how you efficiently access liquidity in different geographies?
To a big degree, we are on the same page of actual costs. The costs upfront of setting up the service providers, the maintaining cost, then the cost of actually monitoring all your systems and adjusting them to the new routing plans. So our teams are working hard to actually prepare for the move and to establish all the service providers now. In terms of the latency, yes, we are outliers, so we would enjoy lower latency to this new center, which hopefully increase the hit rate. The problem that's not the only thing which concerns that, and that's this IOC hit rate, that it's important for the best execution, but that's just one of the pieces of the puzzle. And increase of this hit rate doesn't immediately translate into much better execution for the clients, because you have many other sources of liquidity. And the problem with the thing which concerns us, it's again about the latency, but the indirect impact of this latency onto the execution quality. Because basically now with increased latency to London, where with increased technological pressure on many market participants and the market makers, so there potentially could be some opportunity for the latency arbitrage traders to profit from the stale quotes at the Bergamos versus the UK MTFs, which could, not necessarily will, but could have really adverse impact on the quality of the liquidity, because this technology, this pressure being adversely selected of market makers, they will put it into the risk models. They will widen the spreads that they quote, and the widening of the spreads that they quote will have a direct impact on the best execution. So what will be, will this actual scenario realize this? You never know, because it's a complex system. You cannot really predict complex system in any reasonably reliable way. So we will see. We keep our fingers on the pulse. We hope, we prepare to launch on the day one, but and then we will see how we need to adjust our systems to account for those effects.
Thank you, Vladimir. I think all of those very interesting insights, all very good answers, to be honest. And it's true, there's so many competing factors that, from a liquidity perspective, I think you summed it up really well, Vladimir, which is that I think the whole market, us being an exchange where we know the MTFs are trading Swiss and Spanish equities in London, and we're trading as a primary on the continent. What the impact to spreads and liquidity quality in a post Euronext Bergamo move from London to Bergamo is going to be something we all monitor closely, working out where is the advantageous to be place to be located, and what does it mean for market makers and different types of market making firms. Thank you. Let's jump on to one further question. A chance for you to hopefully talk about some USPs, unique selling points. With so many flavors out there now of similar algos in the competitive market, everyone has a VWAP, but of course, more intellectual property is applied on liquidity seeking and other algos. How do you seek to differentiate your product from those of your peers? And maybe starting with you this time, Sal, what's the internet take on that?
Thank you. I think we've all kind of alluded to that at the point. I think we all have slightly different takes on what makes us slightly different. We have slightly different approaches, and I think for us has essentially, using those two pillars that I referenced earlier, quality of execution and access to liquidity. That kind of segues into an area we've been focusing on quite heavily, actually, which is, and I know it's a bit of a buzz thing at the moment, and you hear it a lot on panels, but the kind of machine learning, artificial intelligence side of it, which essentially, having something on the bones that has dynamism. So a dynamic trading optimizer that constantly recalibrates and chooses optimal behavior for the given scenario in the market or that stock at that moment in time, and it is constantly evaluating, picking up different inputs from various things, whether that's prior executions from lit and dark, from periodic auctions or scheduled auctions, and some of the things around the volatility and constantly evaluating and recalibrating. So that's where we've invested heavily recently. We're live with a product we call MAS, which is Micro Adaptive Sequencer, which has been a few years in the making, and that's live now. And essentially, why does it matter? I think what we're trying to achieve, all of us ultimately, is avoid market impact, reduce trading cost, account for volatility, momentum spread, and reduce that kind of outcome to make sure that when we deliver quality or execution, that it's a quality execution. So I think how this evolves over time is allowing the MAS offering, so the microadaptive sequencer, to take more independent decisions on its own, rather than allowing humans to recalibrate as they start to see things and to meet its objectives. And then as this evolves, potentially the next evolution is catering it to specific client needs. And I think, you know, my fellow panelists have alluded to this point. Different clients have different needs, different flows, different expectations, and perhaps recalibrating it to different strategy types, perhaps different PM behavior types. Incorporating various alerts. We all, I'm sure, have millions of alerts when we're looking at stuff. Incorporating those alerts and acting on them, rather than requiring a human to then recalibrate and adjust. And ultimately to reduce that standard deviation outcome, to make it consistent. So that's really where we've spent a lot of time on the Algo platform, focusing on recently. In addition to that, I guess the block point, you know, we've been heavily pushing and expanding our block cross offering, which is again access to liquidity, or unique liquidity, as we would say. But so those, you know, continued access to block liquidity, and delivering smarter, re-optimizing, re-energizing, and recalibrating flow types to suit different particular flow scenarios and buckets.
Oh, that's really interesting. Trying to be, I guess, more reactive within reacting real time with that AI to respond to where you see liquidity and the most recent trends. Same question to you, Vladimir, from a Vontobel perspective. What do you see as where your efforts are being applied to differentiate your product, or where do you see yourself having a differentiated product from your peers?
Well, we on the similar page with Salon that I already said, the view is that the performance will be the key driver for the choice of the brokers on the buy side. So that's where we put a lot of efforts to optimize, to minimize the possibility of having the non-performing signals in our execution strategies. We launched this opportunistic Algos, which is built on top of the in-house based signal libraries, and we want to use it as a platform to further grow within the scope of the statistical and machine learning to deliver the best possible execution with respect to the rival price or VWAP, depending on where we optimize to. However, one thing which I think Vontobel is which is important within Vontobel is that we're Swiss, and as we're proud of being Swiss, a lot of things in Switzerland is based on the trust, and this trust to the clients is something that we maintain and put a lot of effort, and it's based on many pillars. So performance is obviously one pillar of this trust, but another pillars are technological stability. So we put a lot of effort to having no possible scenario where we can have a major outage. We happy not to have any, even during the 2020 COVID sell-off. We work closely with the client, so because the client's getting sophisticated, but still they don't see your system, so they cannot look into what's inside, and you need to educate them to show how to properly use the algo. Because if they misunderstand it, they will send it in a completely wrong market environment, and they get bad execution, bad performance. You end up blacklisted in the algo wheels. So that's what we try to avoid, to help them to optimize their systems, to minimize the complexity, also from the order sending type. So we want to minimize the complexity burden on the client of choosing what to send. And another one is that we try to we treat all our clients equally. So basically, we don't separate internal clients like the other desks of Vontobel, like the structured product desk, and external clients. So something which we deliver internally and develop internally, we have to offer to external clients without any preference. So I think that's another important part, together with obviously striving, doing the best on the technology, on the algo development, on the optimizing the systems, which is also quite important here.
All right, thank you. You're not going to need to tell a salesperson such as myself that the relationship is important. We become redundant if it goes away. So thank you for that. And I think everyone would agree that, you know, making sure your client understands what your product is, how it should be used, is such a key and important factor, even as they become more complex and advanced and quantitatively driven. Matt, your take for this, JP Morgan, how do you differentiate your product from everyone else's?
Yeah, so I think Sal and Vladimir have mentioned a lot of the kind of the key points. So I won't go into a huge amount of detail, but I think performance is paramount. Performance is key, and that's our laser focus as a business globally, to make sure that we're laser-like focused on client performance, whether that be measurement or customization and the like, to make sure that we are performing to the best of our abilities and exceeding, you know, clients' expectation. That performance angle, I think, is important to remember. That has a both external in terms of client view, but also internal angle to it as well, making sure that we're constantly reevaluating the performance of our stack, challenging the assumptions that we make around how we source liquidity, for instance, and making sure that we are testing those frequently and not being held to a particular view. I think that's important as well. On the human point, and Adam, hopefully you'll be happy with this as well, we do see value add from the coverage side. I think, you know, having a kind of mid-touch service and having someone that you can trust at the end of a phone or an IB is really valuable. And even in this period of, you know, increased electronification and electronic growing in market share, that's still very valuable. I wouldn't, you know, in my liquidity hat, it would be remiss to not talk about liquidity provision. Systematic internalizers for us is important, both in terms of internal and external activity. We mentioned the principal point before, and innovation, bit like what Sal mentioned around, you know, developing models and making sure things like market impact calculations are cutting edge. In some ways, that's the kind of nuts and bolts, and, you know, people expect that, don't see it as behind the scenes, but that's a key focus for us too. And last but not least, and Vladimir, I'm going to take your point around resiliency. I think that's a big expectation our clients have on us, and, you know, resilient systems is something we really focus on. Is probably one of our most important objectives at JP Morgan.
Oh, great insights, thank you. And I guess that kind of wraps up our formal questions for this, but I'm going to flick over now to the Slido, and I see we've had one question in that's really interesting, and with the ambition to give Andre a couple of minutes at the end to wrap up for us, maybe whoever would like to jump on this first, please do so, and maybe we have time for more people to give it a crack as well. But ETF algos, is there any innovation in the pipeline from either three of your houses to, I guess, enhance offerings or develop ETF-based algos? They represent a bigger and more important part of the landscape of the trading day, but the offering in the market still seems limited. I open the floor. Who would like to jump on that? ETF algos.
I'll jump in quickly. I think the short answer is yes, and I think all three of us will probably say yes, but it's easier said than done, I guess. So, you know, you're constantly fighting, and I'm sure we're all very familiar with, you know, things like prioritization lists and meetings, and what's more important, you know, the relative importance of item 1 versus item 2, customizations, and so on and so forth. You know, regulatory change that we have to implement, or risk change, risk items that we have to implement, whether that's compliance as well. So there's a whole host of to-do lists, and I think it's something that's definitely on the list. It's just a question of, I guess, getting to it. We have a finite set of resources, right? So we can't deliver everything else. But I think the answer is yes. But you know, watch this space, I guess, is all I'd say. But yeah, definitely something we're aware of and looking at.
And I just to add to that as well, I think that there's a question of prioritization, which is, of course, every business has that challenge. But I think client demand is a critical one as well. I think, looking at the US market and the dominance of ETFs in that space, and people look at that and say, why is that not happening in Europe? I think, clients do have a particular way to trade ETFs, and that's not necessarily through electronic channels. And I think that we don't see clients really knocking down the door for us to develop these things. So that has another extra dimension in terms of how we think about ETFs. So again, we'd say that it's something we are interested in and develop and discuss internally very frequently, but it's not something that we see the clients really kind of pushing us to develop at this time.
It is pretty much same here. So we see the growth of ETF flows, which calls to higher automation. But in terms of developing a specific algo, there, like everywhere, there should be a clear business case where your development costs and maintaining costs are compared with the benefit for the company and for the client. So far, it is not in the near-term plans.
No, thank you. Great answers. Maybe just a soft plug on our side. I think one of the things we're really looking at around this space of ETFs and algos is obviously, and Matt, you alluded to it, RFQs are, the de facto way in which most ETF value is traded in Europe. And we obviously relatively recently launched our own on-exchange RFQ offering, which has been growing nicely and developing some real traction, particularly in Switzerland. How we can bring a segue to bring RFQ and algo together is something we're focusing quite intently on our side, which then might, watch this space. Maybe we have some interesting conversations with sell and buy side moving forwards. I want to say a massive thank you to you, Matt, Vladimir, and Sal. Fantastic insights. Thank you for lifting the lid on your businesses and what's driving you at the moment. I will hand back to Andre now to wrap up. And hopefully everyone's found that insightful.
Thank you.
Thank you. Yes, that brings us to the end of this webinar. So a big thank you to Adam as a moderator, and obviously thank you very much for the panelists who brought us really great insights into this never-ending algo discussion and dark books and so on. And also thank you to the audience with really a huge number turning up. And I hope you also learned something. You also had some good ideas from this discussion. And again, thank you to all of you. So the only thing I say now is the next BörsenTalk on Mittag is in March, the 23rd. And this time we will talk about ETFs. So the last question was a nice introduction to the next one. So it will be March 23rd. Invitation will be sent out as before. And the working title at the moment is Active Against Passive. Obviously, this year is a bit different to others. So let's see whether ETFs can score again massively as they did in the last couple of years. So thank you again. Join us again and have a positive trading day. Gute miteinander.
Thank you.
Thanks,
Thank you, everyone.